Good afternoon, my name is Oliver Giovoni and I'm a student at Scaresbury Hall School here in the UK. Today I will be presenting my investment thesis on Lockheed Martin, ticker LMT, currently trading at approximately $612 per share. Lockheed Martin is the world's largest defense contractor, operating across four main segments: aeronautics, missile and fire control, rotary mission systems, and space. 72% of revenue comes from the US, providing stable government-backed demand. However, international F-35 exports have increased in recent years. Notably, in 2025, Belgium and Finland received their first F-35s. Lockheed Martin is led by James Tyssler, who has served as chairman and CEO since 2020. Prior to joining Lockheed, he was CEO of American Tower Corporation, where he scaled a business from $2 billion to $100 billion in market cap. My signal is a buy with a price target of $720 and 18% upside for the next 12 months. My investment thesis is built on four core pillars. First, Lockheed operates a recurring revenue business model. In 2025, they reported a backlog of $194 billion, which accounts for 2.5 years' worth of sales. Second, the company continues to invest in next-generation innovation. Third, the rising global defense budgets positions Lockheed at a great place to benefit. Finally, backed by strong financials, I believe the current valuation does not fully reflect Lockheed's growth potential. The US defense market is approximately $354 billion in 2026 and is projected to grow to around $424 billion by 2031, with a 3.6% compound annual growth rate. Globally, the opportunity is even larger, with the defense market expected to expand from $2.1 trillion to over $4 trillion by 2035, with a 5% compound annual growth rate. Lockheed Martin ranks fourth amongst its competitors with a 12% market share. The four primary direct competitors I've identified are RTX, Boeing, General Dynamics, and Northrop Grumman. From a valuation perspective, Lockheed Martin trades at a trailing PE ratio in the mid-20s. This is broadly in line with GD and Northrop Grumman, but significantly lower than Boeing and RTX. This suggests the stock is reasonably priced compared to its competitors. Looking at relative stock performance, Lockheed Martin has delivered the third strongest growth over the past year compared to its peers. However, during 2025, it was actually the worst performing defense stock in its group, despite strong demand for its product. This suggests that Lockheed Martin is still undervalued compared to its competitors and creates a good buying opportunity. I wanted to talk a little bit about Lockheed's business model. First, the government identifies the need, then Lockheed Martin bids on the contract. If they get the contract, they enter a development phase where they invest in R&D, and then they enter a production phase. This is where most of the revenue comes through. However, they then enter a lifetime support of recurring revenue through maintenance and repairs. Lockheed Martin operates in a highly defensible industry structure. I've analysed this using Porter's 5 forces. First, customer bargaining power is relatively low due to high switching costs. Competitive rivalry is also limited, as competition primarily occurs during the initial bidding, while contracts themselves are long-term and often sole source. Supply power remains constrained because of Lockheed's scale and purchasing power leverage. Lockheed is also fortunate to have very few substitutes for the F-35 program. One to mention is the Russian Su-57. However, it's unacceptable by the US and allies due to a lack of interoperability and geopolitical constraints. Entrants pose minimal threat due to technical constraints and barriers. This also requires a lot of capital to enter the defense market. Upon listening to the Q4 2025 earnings call, I've compiled the most important notes from each segment. Firstly, aeronautics is the most important segment as it accounts for 40% of total revenue. Its core driver is the F-35 program, which remains the world's most advanced and widely adopted fifth-generation fighter jet. It had a record deliveries of 191 in 2025 and a 5 times quicker production speed than any other Allied fighter program. The segment also benefits from ongoing innovation through Skunk Works, such as the autonomous drone wingmen and the NASA's X-59 quiet supersonic aircraft. Financially, in 2025, sales grew 6% year-over-year to $30 billion. However, operating profit declined due to classified program charges. Looking ahead, management expects steady production levels following a $1 billion investment in spare parts. They also expect single-digit low-level growth. Next, we move on to rotary mission systems, also known as RMS. This is the second largest segment. A key innovation area is a Black Hawk helicopter fully powered by AI. They have also advanced in directed energy weapons such as a Helios laser system, which provides a low-cost alternative to a traditional missile defense. As a negligible marginal cost due to it mainly requiring electricity, and it shot down 2 UAVs in 2025. I believe this diversifies Lockheed from only producing missiles. Financially, sales were stable at around 17 billion, and in 2026 they expect once again low single-digit growth. However, they expect to integrate into bigger projects such as the Golden Dome. Next, missiles and fire control. It's Lockheed Martin's fastest growing division due to rising global demand for missiles. Key programs include the PAC-3 and the THAAD interceptors. They both received a 7-year framework in 2025. They've also looked at other projects such as the Comet missile and the block pods. Financially, the segment delivered a strong performance in 2025, growing 14% year over year. Looking ahead, management expects the double-digit growth to continue due to a multi-million-dollar expansion in missile production. This is due to James Tyslett believing that missile demand will continue to increase in coming years. Finally, the space segment focuses on advanced missile defense, satellite systems, and next-generation strategic technologies. It's the smallest but second fastest growing. A future initiative is a space-based interceptor program, which is expected to be integrated with the Golden Dome project. Financially, the segment delivered a steady performance in 2025, with revenue growing 4% year over year, and operating profit increasing 10% year over year. Looking ahead, management expects continued single-digit growth and also to be integrated with missile defense. Artificial intelligence is becoming a core competitive advantage for Lockheed Martin across multiple defense domains. AI can be used in cybersecurity to detect threats. It can be used to enable flight like the Black Hawk helicopter we talked about earlier. It can be also used in current systems such as YIS. I also wanted to touch on partnerships. Lockheed Martin sees itself as an integrator with startup technology to create big projects, such as for the Navy with Sail Drone, which is an autonomous surface-to-air vessel. In recent months, we have seen geopolitical tensions rise. We believe that this may increase the defense budget. Trump himself has pushed for a 2027 defense budget increase from $900 billion in 2026 to $1.5 trillion in 2027. This will be a 66% increase year over year. This positions Lockheed in a great place to benefit from this. Looking at financial performance, we can see Lockheed demonstrates strong, consistent profitability, with operating margins ranging between 10 and 12%. In terms of growth, revenue has been modest but stable, generally in single digits, which reflects the mature nature of the defense sector. Free cash flow has declined in recent years. However, I've investigated this, and in 2025, Lockheed Martin paid for pensions upfront, which will free up some cash flow for 2026. The low capital intensity and strong cash conversion can create consistent dividends and ongoing share buybacks. As seen in the previous slide, we have seen EPS fluctuate in recent years. However, in 2026, Lockheed Martin expects a 40% increase in earnings per share to around $30 per share. This rebound is driven by improving program margins, expanding missile production, and normalization due to one-off cost pressures. Beyond 2026, revenue is also expected to rise to around 80,000 in 2026 and continue to grow stably. My valuation is driven from 3 calculations: a 5-year valuation, a DCF post-earnings, and a DCF pre-earnings. I used a 3 to 3.5% annual growth rate in revenue. However, I believe this is quite modest, as some segments such as missiles are expected to grow at double digits. I also used a terminal growth rate of 3% aligned with GDP. This gave me an average of $720, which I believe is more than fair for Lockheed. There are several risks to consider. Firstly, there may be delays with the Golden Dome project. Also, there may be a lot of concentration in the F-35 project and reliance on that. Third, there is a lot of financial pressure in recent years with weakening cash flow. Lockheed Martin is very conscious of its environmental impact. It has been known to help with fire control in its local area, especially in Colorado, and it's also been known to help out with hurricanes and hurricane detection in local areas. I've attached my DCF and the record aircraft deliveries. Thank you for listening.